Good morning. Good morning to everyone out there. It's another Saturday, the Heyward CPA podcast. We're live and direct. Got a new setup. I'm in a different studio today than I was last episode. Um, I'm always constantly moving. Things are constantly going down. So this Saturday, you have the it's just me. Brother Kory is proctoring, well, not proctoring, but he's hosting an event with the Black Chamber this morning. He might pop in, oh, good morning. Good morning. He might pop in at any moment for a brief to say hello to our people and our fans. and but other than that, you got me. So as always, you can put questions in the chat, or you can email them to us if you want us to do a little more work on there. So when it's just me, I kind of do a radio format deal. So I'll talk, give you some insights. It won't be crazy, but I guess I talk a lot even when he's here. But anyhow, do a little more of the radio format. So today I have a bank of questions that was submitted that I'm going to cover. Of course, it's behind the tax game because we're a month and a half after the deadline. So people are just kind of, they're a lot. The adrenaline has started to slow down now. The deadlines pass. People that have extensions, they're not under pressure. They're like, oh, everything is cool. And they're not trying to, they're just trying to chill out. Because no one thinks about, like, tax professionals, we think about taxes, but other people don't. They don't love it. I get it, y'all out there. Y'all don't love it. It's fair. I don't take it personal. It's okay by me. Don't have to love it, but you gotta do them, and that's where we come in. But anyhow, and as part of me, I'm getting used to this new setup, so see what's going on here. So I'm going to answer some questions. Go through a couple of things. But I do want to hop off on, before we get into that, I want to talk a little bit about the tariff game, because we're going to talk about the tariff game as long as the tariff game is there, and some economics behind it and what's going on. It's made for TV, man. My opinion is made for TV. Every time it's put out there, it's pulled back. But retailers are taking advantage of it to raise prices. So that is the challenge that we face. But, someone going on TV threatening tariffs gives people reasons to raise prices. I mean, I did too. Why not? But no, it's true, because I got to buy from other people. So the economics of it, they're wild. But I think we're going to talk about that. We talked about it more on our, our other podcast that we work on, Beyond Next, the Biz Therapy podcast. We talked about tariffs there. So check that out. I'll put a link down in the chat at some point to check out Beyond Next, which we're actually filming this week. But we try to talk about more of the economics, more about economics. And that's another thing. If you don't know economics, you might want to look into economics. So so you have some ideas going on other than what they tell you on TV. All right. So without further ado, I'm going to get to the question bank. And as I said, if you have any more questions, holla, put it in the chat or email us offline and we'll get to you. So I'm going to start with this one. Let's see. Let's bring up the question. What if I owe money and I can't pay it all right away. Big time question there always comes up. What if I owe money I can't pay it right away? Well, there are a couple of things here. First and foremost, file the return. Too many people come up and say, oh, I owe. I don't think I'm going to file it now. Well, guess what? Not filing it does not erase your requirement to pay the liability. In fact, you make it worse, which I've mentioned before on a failure to file penalty, which maxes out at 25%, just for not filing it. That's it. So you got to file your return. That's first and foremost. That wasn't in the question, but I'm just answering that. Now, if you owe money, a couple of things happen. One, you could pay it with the return. Go ahead and pay it in. Or two, you could get an extension, a short extension to pay it all. 90 days or something from the due date. You could get that. They give you a little bit of grace if you pay it. Or the option that is most popular, you set up an installment agreement. So the installment agreement right now, there is something that's a streamlined installment agreement. Straight up 5 years. If your balance qualifies, it's a lot of things. I'm not going to get into the weeds, but you could get an easy one for 5 years. You could get that. You straight, you amortize it. Or you submit your financial information to get an affordable payment, and they set it up right away. But the most important thing to know is, one, file it. This goes for the state too, whatever state you're in. States are more aggressive because they have fewer taxpayers, so they're very aggressive. They'll go get you. They'll come get you. They'll come holler at you. So you definitely want to do that. So go file your return, get it in, do an installment agreement, and that's how you deal with that. Now, why you owe, that's something we get to in a little bit with a later question. But first and foremost, this was the layup. I figured we answer right here. What if I owe money? So, and most of all, well, I'm not going to say that, but there's no one's fault if you owe money. Just incidentally, I just want to say that. So that's it. That's the answer right there. Don't forget. Here we go. We're answering questions today. It's a Q&A day, light day. Kory's out. Very light. We probably give you a little less than this. The weather's nice out here, so we're gonna have a little shorter episode today so that you can get out and about, do your thing. So we're just gonna answer questions like that. So let's get to question number 2. Let's do this one. Okay. This is good. I just got a letter from the government, and my heart immediately sank. What's the first thing I should do? Once again, I've been doing a lot with behavior stuff too. All right. Once again, open the letter. Now, I know that sounds obvious, but you would be surprised how many people just do not open the letters. You gotta open the letter. See what's in the letter. Even if you don't quite understand it, open it up. Not opening the letter does not mean that the issue is not still there. So open the letter. That's the first thing you do. Next thing you do, read the letter and see if you understand what the letter is saying. Nowadays, well, it could be either. It could be in a collections letter. which means that your return was filed. You owe some money. We haven't heard from you, which is what's going on. Or it could be an audit letter. The audit letter is saying, hey, there's something on this tax return. Either we need more information, or usually the letter says we need more information. That means they're examining the return and they're like, yeah, we need to see some more about this because we're not too sure about this. So make sure you start with it opening the letter. Now, once you see what's going on, and you be like, oh, this is too much. If it often they just want like a copy of your, hypothetically, a copy of your W-2, or the state might want a copy of your federal return in this round. They just might want something. So often it's just responding. Sometimes it's you agree. You're like, yeah, I forgot to put my stock sale in there, and they calculated it for you, and you're like, yeah, okay. So all the letters aren't the same. So you want to get in there but read it. And then ultimately, if it's too much and you're like, I don't know what this is, and you start getting high anxiety, call a professional. Call a professional to represent you before the taxing agency. Now, there's something to be said here, because check it out. You know, if you, there are many things in this world we could do ourselves. A lot of things, lots and lots of things. And you could represent yourself before the government in this case, right? You can. But what we find is you're probably going to talk too much. Most likely. The anxieties kick in. You worry. It's like going to the principal's office and you trying to, you dry snitching on yourself. You start talking because it's, the anxiousness, you do that. Not that they're looking for anything, but sometimes clients will start talking and then they open up a new can of worms that weren't even, wasn't even in the mix. They might be saying something about, oh, hey, we were just trying to double check your W-2. And then you bring up some, exotic art sale that, should I have reported that? Well, yeah, now you told them. Great. Okay. But anyway, I'm not saying, I'm not no tax cheat, by the way. I'm just saying, people start talking and that's what happens. And then they get in a bigger jam. So that's why you hire the professionals. Number one, the professional is not them. So they don't have the same personal linking to it. They're not going to be as affected. LinkedIn, like, oh my gosh. We're going to be calm and cool because it's an issue to get done. Two, sometimes these things require research. And there are a lot of administrative procedures that the IRS issues and adheres to that we know where to go to and deal with it. We know how to work with it, and three is knowing how to deal with the different types of personnel. Revenue officers, for the most part, on the federal level and most in the state, they call revenue officers. They're out there to collect money. They're there to collect bread. And that's what they do. And usually they're kind of not the most chipper people in the world. Some are though, but most of them are not that chipper, because if it gets to an agent, that means you ignored quite a few letters. And when you ignore letters, that's why I said you got to open the letters. Do not ignore these letters, because when you ignore letters, that's when they start saying, "Oh, okay, you're not gonna, you're not gonna respond." Okay, guess what they do after that? They garnish you. So I love when clients come up and they say, "Hey, they took my money or something." Listen, you heard the train whistling, you saw the train down the tracks, you knew the train was coming. It was coming. So you should see the conspiracy theories and everything. It's like with people that know they owe the money. But anyway, but they never, then we get them and they give us a stack full of letters like this. Oh, I didn't open them. Okay, that's great. Like 2 years old, 3 years old. So open your letters, people. And, it's open the letter. You won't disintegrate. To date, the black helicopters won't come for you. Just open the letters. Talk to a professional if it's really over your head, or if you just, you're like, I'm not sure about this. Talk to a pro and deal with it. So, but your heart's sinking. And I will tell you this too. Audits or questions, it does not mean that your return is wrong. People love to say that. They come back and they say, "Oh, well, you did something." Well, actually, you did something, because we reporting what you gave us and what you did. So you have to try to, look, it's a situation that come up. They changed on the IRS side. They changed the audit situation every year. So there's algorithms. We all know algorithms. You're dealing with some algorithms right now. If you're watching this on Facebook or YouTube, algorithms in there. The IRS uses algorithms to decide who they're going to audit in a given year. So look out for anybody that tells you I guarantee you will not be audited. They don't know what they're talking about, because who the heck knows what they're auditing. All right. So that's what you do with the so don't let your heart stop. Just, deal with it. All right. Listen, this is a follow-up to that. I think I answered to it one time. If the notice asks for more information, proposes a change, what's the best way to respond? Should I handle it myself? Yeah, once again, the best thing is really look at the notice. On the IRS notices, they are very clear. They're usually not complicated, especially if they're asking for information. Those are usually what we call CP 2000s. Their correspondence audits. They just want some documentation to verify something on the return. Sometimes it's one form, sometimes it's something. Now, sometimes it's a little more complicated, and you need to come in, get somebody to put some stuff together for you, so we answer it properly. Or if you don't, like if you're Schedule C filer and you don't really have any books, and they ask to see your books, we talk about it all the time. Keep your books. Can't really, it's hard. It's very difficult to go behind a year to look up something. Like you spent something a year ago and you're going to remember, or you went to Walmart and you bought a pack of paper for the office along with your groceries, and it's all caught up in your billing, and you don't, so what you do, you deduct the whole bill, and they're like, your office supplies are out of whack. What are you doing? So that's another reason I always plug it. Keep your records, folks. If you're in business, keep a set of books, because this is another reason here. If they want proof, you got to be able to give it up. So that's the answer there. But yeah, you can totally handle it yourself. But remember, you got to open the letter first. So let's see. Let's go to the next one. Let's see. Let's do this question here. Let's talk about something. This one's a little bit better. It's a little more positive here. Right. You talk about year-round tax planning. What does that actually mean for someone like me, and why is it so much better than just scrambling at tax time? Well, that's a good question. Let's break that down. Year-round tax planning is very simple. It's planning. It's like anything. You plan. Well, when people used to plan, I'm dating myself. What do you call it? Christmas club. When you go to Christmas club, you used to put money in for every month. You make plans to put money aside to buy gifts. You plan to buy a house. You plan to have a family. You plan to get a degree. You plan to finish school. You plan to start working out. Well, you should plan to pay your taxes too. So right there is just a case of, I've said it before, and I'm trying to hit it home with our listeners here. Look, no matter, we're United States citizen, you're a taxpayer, okay? um the tax environment is so complicated now. It's complicated, well, complex. I don't know. It's not hard, but there's a lot of moving parts. And not just that, the economics are changing, you know. Like, none of us are really away. We might be the small folks or whatever, but we're being impacted by these changes in the economy and the tax world and credit facilities and things like that. That I personally do not feel like you can afford to not pay attention to all aspects of your finances year round. I just think you need to do it. Personal, yeah, okay. I mean, I live in the world, so yeah. But what I'm trying to say, as someone that lives in the world and speaking to people that don't, having 10, 12 months where you don't really pay attention, I think it's going to be detrimental to people in the future. Because one thing is, hey, all these cuts and deficits or whatever, so at some point someone's got to pay something. I don't know who, I don't know what generation gonna get caught with it. I don't know what's gonna happen, but something's gonna have to happen. So you have to be in tune to what's going on. So year-round tax planning, and let me break down tax planning. Tax planning doesn't just mean tax reduction. Sometimes it's cash flow of tax payment. How am I paying it? When am I going to pay it? Am I going to defer stuff to next year? I know I'm making more money next year. So this year I'm making less money. I'm taking a loss here. I got a loss. At the end of the year, I'm going to harvest some of my stock positions to take a loss because I had a big capital gain this year. So I'm going to take some of these losses to offset that by selling stock, selling some of my stock. So it's not just hocus pocus of, tax planning isn't, can I deduct my dog, which, by the way, you cannot. Special circumstances you might be able to, but I don't know. But you can't just deduct your dog as a security system, like some people like to say on the internet. Because I know darn well my dog ain't no security system. I couldn't. Even if you could do it, I wouldn't use him as a security system. So anyway, but you want to look all year round. You want to pay attention. So, one thing you can do, you did your tax return. You look at the total tax line of your return for this, what we just finished, 2024. You have your year-to-date pay stubs. You can look federal income tax, or if it's you and your spouse, look at the year-to-date, the federal income tax, and you can look and see if you on target to pay at least what you did last year. If not, you might make an extra payment. You might change your W-4. Guess what? That's tax planning. It's planning, like I said, with the person that claims that got garnished. The train is coming. You know the train is coming. So it's coming. You got to pay. You might get money back. Whatever else, we all have a tax obligation based on the amount of income we make. So that. Go look at it. It's okay. I mean, when I say tax planning, it doesn't necessarily mean, call us, blah, 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 blah. I mean, I love to because, we like providing services to the people. But pay attention to what you have going on. If you're going to make a move, the big one that happens way too much, people have a situation and they go to their 401k and make a deduction. They take money out their 401k. and they mistakenly believe that the 10% that they make you take is going to cover what you have going on. If you have to hit your 401k outside of taking a loan from the 401k or 403b, you need to do a projection, because you probably need to take more money. Not probably, I'm promising you need to take more money than you did to cover the taxes. Off top, that's where it hits home. That stuff, because understand, I've said this last episode, and I'm gonna keep saying it because people don't listen. When you take money out, if you're a salary person, you're a wage earner, and then you send something out, you take some money out your 401k, that amount gets added to the other money you make, so it pushes your tax liability up. The 10% they take out is for your penalty. If you're not 59 and a half, it's for your penalty. It's only 10%. But people don't. This is another example, as we said, attention to detail. Here's the problem. People don't know what their tax rates are. They don't even know that. So read your tax return. That's why we started doing videos of the tax return. We realized people, they don't read tax return. They don't read them. They just want to know the bottom line. Hey, am I getting a refund or I'm paying? That's all they want to know. Which I know that's the bottom line, but read them. At least know some things. No, I'm in this bracket. No, I'm here, there. So you know something. And then you can plan. It's another bill, folks. It's another bill. Taxes are another bill. That's what they are. It's like taking cough syrup. Want the cough to stop, the taste is pretty bad. And unless you have a NyQuil habit, you don't want to take too much. So, but you got to pay attention. You had to pay attention to your stuff. And, something that we're trying to get our clients to understand as we do more advisory work is to involve them. Look, you need to know, because people do stuff. I'm not talking to you. I don't know. You took money out for this. Oh, I bought a boat. Clayton, this is my second home. Oh, by the way, I got a rental property now. Something. I find that you buy it like now, and we find out next February. And then you say, well, what kind of ways can we, how can you help us save stuff? I can't do it for last year. You need to reach out. If you got a tax person, reach out to them before you make the transaction. Go talk to them. And you know what? As I know this is a repeat. They might charge a fee, but you're gonna save yourself money in the long run. And you could possibly, treat the transaction better. So that's where it gets better than scrambling at tax time, because at tax time, it's over. I mean, there's not much that many practitioners could do for you after January 31st. It's not much. Not much, It's like the year's over. There's some things, but it's not much. And as I said, with this whole tax planning thing, a big part of it is, how are you going to pay the taxes? It's not automatic of, oh, you're going to get rid of this. We're going to make it go away. It's not always that. It's how you're going to pay it. So as you can see, I'm really into that, because I'm trying to push people. Part of tax planning too. I almost forgot. Estimated payments. That's why they're there. And let's say you get bonuses. That's another place people get messed up. They get a bonus, $20,000, $30,000 bonus on top of it. They make $80,000, they get a $30,000 bonus, which is taxable. Well, your picture for this year looks different. You're gonna owe more this year. That's what's gonna happen. So what are we gonna do? We're gonna holler at somebody. It's not gonna go away. Hey, I got this bonus. What do we need to do? Can you help me calculate my estimates so that I could go ahead and put that in there? Sure. It'll cost you this much to do it. Okay, no problem. All right. That's what we're trying to get to here. That's what we're trying to go to. But you gotta, you gotta get in front of these things. These transactions that affect taxes, you got to get in front of them. That's what I mean. If you people that always, these mythical people that don't pay taxes and all this other stuff, I mean, they get in front. They in tune. They in tune. That's right. Pay up. You know what it is. Yeah. They're in tune. But I'm just saying, tax plan is important, man. Even if you think not, go look at your document. See if you're on track to cover. See if you're at least withholding the same amount you did last year. People take it for granted. Sometimes they're not. I've seen some ridiculous amounts. People make X amount of money and they say like they withheld like $200 for the year. You're like, what were you doing? Oh, I needed the money. Okay, I dig it. And I forgot to put it back. I forgot to put the withholdings back. Okay. Do you still have the money? Probably not. So now you need an installment agreement. You see how it works? Had you planned and looked back and saw, hey. So anyway, the takeaway from that, I'm beating the horse there. But I'm just saying, tax planning to me is almost like financial planners. Like people think they don't need financial planners when they don't have any money. But I ask, how are you going to get any money if you don't have a financial planner? So, anyway. So much for that. So, man, I'm answering these things two at a time. All right, here's a good one right here. Let's go back down the scary train. Right here. All right, you ready for this? Here we go. Can the IRS or the state really take my business, assets, or bank accounts if I have unpaid taxes? Yes, they can. And in the state that I'm in, North Carolina, they do. So they can. I mean, taxes are illegal. You have to, by law, you have to pay taxes. Now, I'm gonna expound on this a little bit more. It takes the federal government quite a while before they levy something. It takes a long time before they actually levy. It's a long time before you levy. You got to go through a lot of departments before they're like, it has to get to when I mentioned the revenue officer earlier. So it takes a while before you get that. So you have time with the Fed. Like if you owe money, you have time according to when you address it. But let's just say we're talking about something you filed this year or even last year, didn't pay it. You have a while with the IRS. Now the states, they move faster. I could speak on this state. They will garnish you. I mean, they will. It goes down and they garnish you. They issue a levy and they garnish you. But I will say this, going way back to the first question, and I mentioned it earlier. Garnishments, and they call that enforced collections. Garnishments are usually because they never spoke to you. They have not heard from you, or they spoke to you. You set up this arrangement. You didn't fulfill the arrangement. You disappeared. You never called back. So I gotta hit you on the head again. Come back. And what better way to get you back than to put a levy on your paycheck or your bank account? You calling somebody, and they tend to do it on Fridays too. I mean, it's serious. Like they do it Friday. You are like, hey, yeah, we going. Could you imagine the people that got garnished last Friday before Memorial Day? Could you? That's the worst. I know they were like, whoa, they were not happy. You know what I'm saying? So you have to you have to go ahead and I mean they'll take your stuff. So the so that's the thing that you have to really understand. It's not automatic. It doesn't happen as soon as as soon as you make moves. But they can take your stuff. And also let me explain the difference between a lien and a levy. So a lien gives them a right to your property. In other words, you can't sell it without them getting paid. That's what a lien does. A levy is the enforced collection when they actually go in and they go to liquid. They mostly go to liquid accounts. Usually foreclosure, they're not foreclosing homes. That's that. Because remember, it's they don't want your house to have to go sell it to get the money. That's just like out of control. That it's they're not trying to do that. They will if you really get slippery, but that's not what they do. I had a case with somebody, and it's not all property is not good property. This client had a property that the IRS said, we don't want that. It was too messed up. They're like, we don't want that. What are we gonna do with that? You keep that. You still owe us the money. So, coming to get your house and all that. Yeah, that sounds great. But yes, on Fridays, they've garnished people on Fridays because that's when the money's in the bank. So the way that the garnishment works is it's sent to the bank or to the employer and is executed when there's enough money to do it. And it's usually a one-time thing, the levy. And so if you keep if your balance has nothing in it and then you get paid on Friday and bing, ding, 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 ding. I'm in North Carolina, they can only take a certain percent out, but usually people are on the margin. So they take out, $300 at their paycheck, or they send their employer to take it, then it's bad on Friday, man. I've had people on the phone crying. Then I realized, I was like, wait a minute, you haven't paid your taxes in like 6 years. Anyway. So they but the lien, that back to the lien and the levy. So those are two different things. If you get a lien notice, that means they filed with the court and they said, hey, you're not going to sell this. We're going to get paid if you sell this property. So nowhere to hide. We got you. So but the levy is the actual action of doing that. So to put that in a bow, because I have a nice question from the crowd. In order of operation, pay attention to the states, because they'll come get you first. They definitely will come get you. All states, they'll come to you first. They'll get you before the IRS. The IRS, I'm telling you, it takes them a long time before they levy. They'll send all types of nasty grams and stuff, but for them to actually go in your account and get it, they will. You know what I'm saying? And over enough time, they will. I'm saying, work on your state. If you owe, make sure you do that. But you get in your state installment agreement, you're good anyway. So, but all those seizure sales, and also let me talk about, because everybody talk about like Red Fox, so King took all his stuff and all that type of stuff. Your debt has to be, remember, it has to be enough for them to pursue it. They want to, so it costs them a lot of money to go after these cases. It's just like the FBI. When the FBI brings a case to somebody, they know they're guilty. Like they know because they can't miss. The cost of the resources, which ironically is our tax money, they can't miss. So the IRS is not going to go. It takes them a while to be like, oh, this person just not trying to pay, so we gotta go see them. So, but the states, They're a little closer to the situation. And oh yeah, by the way, if you happen to work for the state, it'd probably be a good idea to resolve the tax issues you have, because they certainly can find you. But I digress. Let's see. Donna jumped in late, and this is not a duplicate. One answer: she applied for a discount or rebate on property taxes. If she gets the discount, will she get a refund for the 2023 property tax I paid? I'm going to answer this honestly. I'm not sure. The way they're doing it, because the assessment, and this is local where we are now, but most of us live in these areas now where, especially if you're in the South, they're doing a lot of reevaluation of property because the prices are shooting up. So, you know, but the property tax thing, I don't know. I think it's for the coming assessment that they're doing now. I'm not sure if it goes back, if it's retroactive to your previous tax, the property tax deal. The thing that, the presentation our church did a presentation on this, but I believe it's to the what's coming up currently. But I do believe there are things that you can apply for. I think it might be separate, maybe for the relief, but I'm not sure. But I'm pretty sure that the relief that we were discussing is for this new assessment that they're doing, where most people in our county, Durham County, property tax, the valuation of the homes in a lot of cases have like doubled, because it's like they're catching up. So they doubled. So not only can you probably not sell your house, and buy another one, now the taxes are doubled. So, and this is happening throughout the country though. A lot of places is happening, places that have built up through the Sun Belt, and people have moved, and people are constantly moving to these states. And, the governments need revenue for growth or infrastructure. So they're making the residents, step up. Oh, just because someone's house, if you bought your house for like 150,000, you good. But then in your neighborhood, houses start selling for 500,000. You paying taxes on 150. They're saying, "Oh no. Your house is worth 500,000." You're like, "What? Huh? What?" So, but there's ways to get relief, and there's ways to appeal that. You could appeal the valuation of your home. So that's where that comes. Good old property tax throw in. I love it, but I'm pretty sure it is. But I'll look into it a little more for you to see if it's residual. But I'm pretty confident it's about looking forward. That's where we are. So thank you, Donna, for your question. See, it's simple like that. You put in the question on the spot, I answer. And you know what the best part is? Aside from me losing my voice, it's free for you. It's like a free tax clinic for you, so that's pretty good. Let's see. We got a few more questions. Anything else from the chat? Go ahead, put it in there. But it's rough, man. I'm up here. I say I talk all the time anyway, man. So I have another question here. See, some of these questions I answered running my mouth, but but it's like an audit. If I'm audited, what happens when I'm audited? I mentioned that earlier. They look to see your stuff. This goes back to, let's take this question down here. And I'll go put this one in here so you guys can see. I touched on it a little bit, but It's just us. We keep it eye level up here, right? So, that's let me get the question up for everybody. What happens when I'm audited? Or if, I should say if, but whatever. That's the question that was asked. So usually, you just got to prove out what you have. That's why when we do returns and we talk to clients and clients take questionable positions, I let clients know, hey, fine. You want to deduct that. No problem. Now, I will tell you, it'll be difficult to defend that if the position is ever challenged in an audit. So that's a big thing that people have to understand with these deductions. What our methodology here from the time that we started to practice is that we try to look at the return. It's subconscious. We don't do it in actuality, but we look at the return as if we were auditing it. So those of us, our clients out there, they know sometimes we get meticulous about the follow-up because we have a duty, one, as practitioners, as a licensed practitioner. I mean, it's just a duty to do that. That's our professional skepticism has to be there. As a CPA, that's one of the things, one of the tenets, you say, right? But we try to prepare, hey, we're kind of preparing the taxpayer to say, so you saying this legit, you saying it's legit. Now, if you're saying it's legit, okay. We'll probably send you a memo to let you know, hey, we agreed that you'll take this position, but this could be seen as an abuse of code section so on, so on, so on, so on, so. Had to do one this year. Didn't take the deduction off, but I made sure that memo went to him. The memo's in our file. So if it's ever audited, I mean, it's not really saying I told you so, but it's really saying that, hey, we did our due diligence and let you know, because we're here to assist you with preparing the return. But you're the taxpayer. Every taxpayer signs their return. I'm just going to throw this in there. The tax return is your tax return. It's not our tax return. It's your tax return. You're responsible for the tax return. As practitioners, we're responsible for assisting you in preparing the return based on the information you give us. That's the job. That's how it works. So it's yours. A lot of preparers, we try to absolve the taxpayer. Oh, just give me all your papers. Boom, Wizard of Oz. I spit it out. Here you go. And then something happens. You did this. You did that. You did this. Why'd you do this? Then they become interested after that part, right? That's when they become interested. So, as a pro, we do. That's part of our review process. We look and see, and if something is on the edge, I'm not saying that it's not a legit deduction, but I always say, when people ask me, can I deduct this? I say, hey, you can deduct what you want, but you got to be able to defend it. And if it's too ridiculous, I'm not signing a tax return with it on it. Feel free to do it yourself. But anyway, back to I digress. Back to the audits. So, most of them are correspondence. They're done in the mail. People they send stuff, request information, you send it back. They come in, they respond, they're good. But if you actually have a field audit with a revenue agent, you might have to go meet with that agent, and they're going to grill you. They're going to ask you about it. They're going to say, hey, so you bought 3 Lexuses last year, but you say you're a computer programmer. So can you exactly tell me how these Lexuses all are part of your business, all 3 of them, but you a sole practitioner, like that. let's explain that. You work from home. You bought 3 cars last year, but you deducted all 3 of these cars as business expenses on your return. Riddle me this, Batman. Tell me what's going on. I want to know what's up. What's going on? So that's why I said earlier, you want the professional. Because if you sit down with somebody, you're gonna start talking. You're gonna start talking, and one thing here at this firm, you're certainly not gonna be able to say. You're not gonna be able to say, I don't know what he did. He did it, because that's not gonna happen. Because I'm gonna let you know, hey, bro, this is what you're doing. You know, I got that coming up next. All right, that might be our last question. So, you know, the audit thing is, once again, it goes to the year-round planning. It's doing what you do. You know, you said it, but understand these deductions. Every line on your tax return is attached to a law. So you have to understand. But also, one thing we also try to do is make sure the return makes sense. I mean, the return doesn't make sense, I'm gonna be like, this doesn't make any sense, but if you say so, here, sign this, provided by client. Yeah, I told you, man, you know, not feeling warm and fuzzy about this. I don't know. But that's what happens when you get audited. You have to defend your position, and you can defend it. I mean, you know, there may be a reason that you bought 3 cars and you work from home, and, you know, most of your clients are in Singapore or something, but you bought 3 cars for the business. It could be some reason. I don't know. You could be working on remote cars, but you bought a BMW, a Benz, and a Lexus. I don't know. It could be. Who knows? Yeah, well, that's a tough one. That's a tough haul. Or that 10-day vacation you took to Bali with your family, your wife and your 2 kids. That was a business trip. All 10 days. It was a business trip. Deduct the whole thing. See, these are the things people on the internet are saying to you. And I'm saying to you, that's not a deduction. But it's not 100%, definitely not 100%. So, but that's where people start, you know, they start playing around. So that's but what your end result is this. And by the way, this can come about 3 years after you file a return. Don't think this is beautiful. You file it. Yeah, it's in there, but if you get audited, it's like 3 years. It could be like 3 years before they even inform you. Like, hey. And if it's a field audit, it definitely could be about 3 years. And you're not going to remember the story you gave me, which is another reason we write a memo. So there you go. But that's us. You know, we work with pros. Here we go. All right, we get another question from the crowd. Hey, I know that guy. Gregory Heyward. Is money received from the sale of inherited property considered taxable income? Great question. So this is how things work for inherited property, so non-cash property. When the original owner, the decedent, passes away, we have something it's called a step up in basis. So let's just take a house. Somebody's parent passes away. They got a house. They paid like $10,000 for it, you know, 50 years ago. And now it's worth $250,000. So on the date of death or up to 9 months after the date of death, the basis, which is in tax talk, is the cost, the taxpayer cost, you know, on their death, the property becomes whatever the fair market value was on the date of death. So it was 250, it was 250. So what that does If you turn around and sell it, the day after, week after, you have no gain. So it's a tax. It comes out tax free. You don't owe any tax on it because the basis equals the sales price. If you sold it for $250, if you sold it for $300, the $50,000 would be part of the gain, something like that. Now, if you kept the house, so now our basis, the cost of the value of the home is $250, and you sell it 10 years from now and it's $500. Then the difference between $250 to $500 would be taxable, and that gets taxed. So in planning and estate planning, or some of these things, succession planning, that's something people have to bear in mind, that your value, I mean, there's anything, if it's a car, if it's jewelry or something, on the date of death, everything gets a step up. We call it a step up in basis. So whatever the market value is when they die, and there's an alternative date, that's what I was mentioning earlier, that's now your cost in it. And if you sell it immediately, you won't have any gain. So that's the plus in the code for people in inherited property. But usually it's real estate, which is something that it's trickier if you inherit 401ks or retirement plans and things like that. That's a separate deal. It's considered property, but it's a separate deal that works. But yeah, anything that's tangible, boat, car, land, any of that stuff, it steps up on basis. So once again, another record keeping point. You gotta keep records to look at this stuff. Remember how it's coming full circle. You gotta keep the records to look at stuff, because in the rare event that you examined, you have to come up with these details. So you have it there. And I mean, you got to come up with them anyway, so that everything is done properly. And because even like, and you take a property like this, they're going to sell. The closing attorney has to give you a 1099-S. They have to give you one. So they're going to give you this proceeds from sale. Then you do your stuff and show that is there, and it's, it's lickety split. So it's but that is the answer to the question, that when you sell it, it'll be considered taxable, but it's not taxable when you inherit it. Maybe that's the short answer. I gave you the CPA answer, but when you inherit it, it's not taxable. And also, since we on it about the estate tax thing, the exclusion for estate tax is I think it's up to $17 million. So if your estate or your inherited estate is below $17 million, it will not be taxed. So if anybody out there has that situation, let me know. I'd really like to speak to you if you got that situation going on, where your estate, or the estate that you're leaving for your heirs, you teetering in that 17 million range. I mean, let's talk, let's hang out or something, I need another vacation. But anyway, thank you, sir. Thank you for the question. And thank you everybody for being with me, keeping me company this morning as I try to hold down the fort without Mr. Franklin here to keep me from ranting and raving. But I figured the Q&A would be good. Next time we might do something on some economic trends, talk about the market some. Next Q&A, talk about some of the investing in the stock market, how it works, how the tax works with that, why you should, or reasons that you should, or what have you. Either that, we'll do that. But for now, it is 12 o'clock Eastern. I did not think I would be on here for the full hour, but I am, and I'm glad, because I talk about something that I'm always talking about. So I thank you. Don't forget, if you have any additional questions, submit them on YouTube down in the comment section, or you can email us, podcast@heywardcpa.com, with any questions that you have. We want people to ask questions. I mean, in reality, we're here every Saturday. Honestly, is an open house for you to ask questions. Free advice. We come in, you check it out, but you can send the question early in the week, in the 2-week period, and we can get to you. And if it was somebody that you suggest we interview, if we're looking for people to interview. So if you know anybody, we're really looking for small business people. We want them to get on here and tell their story. People that just started, people that are that could kind of talk. We've spent 80-something interviews laying this prerequisite stuff. So we really want to get to the place where we have people on here talking about their situation so that we can crystallize it and people can learn, including us, learning from them what their experience is. So if you have any suggestions, please email us, podcast@heywardcpa.com. And we would definitely love to, any nonprofits, religious organizations, anything, let us know. So with that being said, on behalf of Kory and myself, I'm going to chuck up the deuce and tell you to have a wonderful weekend. And we'll see you in June, which starts tomorrow. Peace.